This is the Texas Land Guys podcast, hosted by brothers Tim Dosh and Tom Dosh. With their partners David Marshall and Trip Rich, they have built DMRE, the leading land brokerage in Texas. With decades of experience brokering deals between landowners and real estate developers, they take you inside the deals that move the market.
Welcome to the Texas Land Guys podcast. We have a full house today. I've got Trey here with me in Dallas, and then Tim, you've got David with you there in Houston. So welcome to the podcast, everyone.
How's it going, guys?
Good. Thanks for having us.
Doing good.
Yeah, it's been a while. We thought it'd be fun to have both Trey and David on. Trey recently became a principal here at DMRE. So Trey, congrats to that. It's fun.
Congrats, Trey. That's awesome.
Trey. That's awesome.
Yeah, fun.
Well deserved.
Thank you.
Yeah, it's hard to believe, 7 years just about?
Yep.
Just about 7 years into the Dallas office. So
yeah,
I'll still run into people that I worked with in Houston that don't realize that we have a Dallas office and then I moved up here, which is pretty funny.
It's been an awesome ride and you guys have been incredible and just amazing partners, and so thankful for every day at DMRE. So I appreciate you guys.
Well, it's pretty cool because the way we started the Dallas office was recruiting Trey to come over from Marcus and Millichap by himself. Oh. And I think, Tom, what did you come up about a year later or so, roughly, and to help Trey start the office? But he was alone for a while.
Yeah, and it was Fort Worth. Mm-hmm. I'll always feel a little bit bad that I pulled Trey away from Fort Worth after I didn't see COVID coming. But I remember I told Trey, no, you don't have to move to Dallas, because Trey was already thinking ahead, which was smart. He was like, are we going to eventually have a Dallas office? You sure we're only going to have a Fort Worth office? And I was like, I don't think it really matters. And then a year later, Trey's packing his bags and moving to Dallas. So
yeah,
that's how it worked out. But yeah, COVID definitely changed a lot of that.
I remember being up in Vail, Colorado, probably at 9,500 feet or so, and pacing back and forth at this place we were staying and talking to Trey about the future of the Dallas office and what it was going to be like. And we obviously had no idea at that point. Yeah. But that's cool. I'm glad it worked out the way it did.
Yeah, it's been great.
It's been a fun change. We took a trip to Israel in early 2020. And so Trey had been with the company 6 months or so. And it was 10 guys from DMRE. And I'll remember Trey and I connected really well on that trip and just had a lot of fun together. And then it was I went back to Houston, he went back to Dallas. And so it was pretty cool to then, we didn't know, but 6 months later, we were basically going to be working in the same market. And and then John came up too. And so we've built the team up here, which has been a lot of fun.
Yeah, that's funny. I remember that because I hadn't even started with the company. I just accepted, and then I got a text from you out of the blue saying, hey, by the way, do you want to go to Israel?
I'm so glad we did it because it's been pretty difficult to go to Israel ever since.
Yes.
And so that was a pretty special trip. But yeah, it's been fun to see Dallas, see the office grow, and the market's been really interesting. Obviously, I wish that we would have started in Dallas when we started the company, if not sooner, because the market's been so strong. But it's still, it's still an incredible place, but it's definitely gotten more headwinds more recently, just with, rates and everything that's been going on in the macro market that has made it difficult for developers to get things done.
Do you think, I'm wondering if maybe the biggest problem we have right now is rents, at least on the multifamily side, just how soft rents are. I know there's a lot of different factors. I know part of it is all these legacy deals that people can't sell that they're holding on to on the developer side and the equity side. But what we're seeing in Houston is some of these areas that were really good markets, like the Heights and Washington Corridor and the infill market, they're just really soft on the rent side.
Yeah, and it doesn't make a whole lot of sense because the supply is way down and there's no new starts. There are very few starts especially in the infill markets, but we're not seeing. Typically in that situation, you see rent growth because there's fewer options and not as much supply coming online. But that's not the case here in Houston. And my thoughts on that are maybe some of it has to do with inflation. Mm-hmm. So they're spending more money at the pump and groceries and other areas of their life, so they have less money to spend on rent.
Yeah, I think you're right, David. I don't know that people are really making that much more money to be able to just continue to pay more and more for rent every year. Because the way that a lot of times the development market looks at it as rent should just be growing because there is natural inflation. But then you look at how expensive it is to go get a 1 or 2 bedroom apartment. And for the average person, the average person's gonna have a really hard time spending $2,000 a month on rent. But that kind of became accepted. All these deals were being built at a level where you had to spend that much money just to make the deal work.
Yeah, and you have all these, the renter that you're targeting a lot of times for a Class A multifamily deal is a young person, getting out of college or a couple years out of college, young professional. And, a lot of those kids are having a hard time finding a job, having a hard time keeping a job. They're the ones who may be getting laid off. We're starting to see that. Or they're just, concerned about the future and they have roommates or still living at home or something like that. So that's just, a pretty big limiting factor for rents.
You guys have been,
And I think that's a trend we might start to see more of. College graduates, I think we already see it. A lot of them move home with their parents, but I think we might start seeing a trend where they move home with their parents and they live and stay with their parents longer.
Yeah.
But with all that being said, at least here in Houston, we have seen a slight uptick in the activity in the infill market from multifamily developers. Still very, very difficult to get anything capitalized, but that has been promising to see a little uptick in the activity in the infill markets here in Houston.
what do you guys in Houston think is driving the better areas from a rent standpoint? Because after doing this now for over 20 years and seeing how it like shifts around from submarket to submarket, there's like the hot submarkets and then there's some areas that have stayed strong the whole time. What do you attribute that to, that, you know, just where if you were going to go out and develop apartments right now and kind of make a bet on where rents are going to be in a couple of years, which submarkets do you think are interesting and why?
I think it's barriers to entry. I mean, I think the only submarket that really seems that strong is Northwest Houston. I mean, you could maybe say Southeast Houston too, like Clear Lake area, but it's because there's high-end demographics and there's, you know, supply constraints. If you look at Northwest Houston, like the Bridgelands area, you know, 290 inside of the Grand Parkway, there just aren't sites left and there's very high-end demographics. And so it's actually the one place we're seeing capital, you know, look hard at deals and deals getting capitalized, even at some really high cost basis, like in the mid 20s to 30 a foot, you know, for the dirt for surface park product. So that's kind of crazy. I mean, that's the only areas that we're really seeing where there's a pretty aggressive buying if you can find a site.
Yeah, I agree. I mean, not to just regurgitate what Tim said, but we have a couple deals in that 290 corridor where they're paying big land prices, but they've got them capitalized. And I think Tim's absolutely right. It's a barriers to entry play. It's impossible to find sites in that corridor. So I think it's barriers to entry. And then I also think it's a site that's part of maybe a bigger development. You know, it's on adjacent to, you know, a grocery anchored retail center. It's adjacent to some sort of mixed use retail entertainment development of some sort. But I think those are the two drivers right there. So essentially it's a barriers to entry play, or it's a site that's got a really good story to it.
Yeah.
It's funny to say barriers to entry. It's kind of an oxymoron in Houston, right? Because people think that there's no barriers to entry. But I was thinking about a couple of the deals that when I was working there did really well. And you had some deals that would do really well in places like City Center, and because they were zoned to really good schools and maybe there was like walkability and amenities. And then I remember there were some projects in River Oaks that would do, you know, really well. Zach Johnson was recently on the podcast, and when he was at Fairfield, he developed a project off Waugh, and he was telling us that that project outperformed all the other projects that they did at Fairfield. So it just kind of interesting, like on those more urban projects, have those areas like a River Oaks or a City Center, has that held up, or has there been too much supply even in those areas and rents have dipped in those pockets too?
Yeah, I would say those have held up. I think the challenge is you can't really repeat those deals now because, you know, well, for City Center, it has to be a true City Center site, you know, because if you go across I-10 or you go, you know, west on I-10, you know, outside the Beltway, it's just a totally different market. It has to be walkable to City Center. There are some really good rents there. If you could build there, you would do well, but you're talking about, you know, $150 to $200 dirt for like the one or two sites that are kind of available there. I still don't think the numbers would work. And then River Oaks is the same way. I think River Oaks is incredible, and we've had some strong rents there. But again, you're talking about, you know, $200 to $300 dirt. If you can even find a site, someone will sell to you. And so the numbers just don't work. You know? Yeah.
I mean, you start talking when you look at, you know, land prices pushing to $200 to $300 a foot, you're getting forced into building high-rise development. And right in Houston, Texas, and probably I would imagine maybe Dallas as well, it's just you can't underwrite a high-rise development. So you either have to be a long-term player in terms of developing and holding it long-term. But, you know, if that's not your strategy, it's just not going to underwrite in today's world. with where interest rates are, rents are, and costs are.
Yeah, you guys actually have some pretty good high-rise rents in Dallas. Not that maybe people are wanting to build more high-rises there, but I think in Houston, maybe our highest high-rise rents are the low $3 range, which is just well under where you would need to be, for new product. But you guys have some rents in the 4+ range, right?
Yeah, we do. Some stuff that's kind of in the low to mid 4s. I think the recent projects have been like Lincoln at Preston Center, Streetlights in Knox, Hanover's deals on Turtle Creek. Those have done well, but I also don't know that they're doing well enough to go replicate. To your point about underwriting a high rise, like there's good rents, but without some sort of incentive or story behind it, it's really hard for anybody to pursue high rise right now.
Yeah, you can't merchant build these high-rise deals, as you guys know. So it always falls in the bucket of long-term capital, build to core. I think the Lincoln guys on their Preston Center deal are north of $5 rents, which is incredible. But like to your point, Tim, you can't replace the site because if you go across Northwest Highway, which it's not like going across I-10. It's called a highway here in Dallas, but it's a couple lanes. It's not that it doesn't have traffic, but like you can cross it. You have deals going from getting over $5 rents to getting $3 rents on a high rise. Yeah. So if you're not in Preston Center, like you said about City Center, it's going to be a big difference and it's really hard to replicate. So Lincoln built this incredible project that's office, multifamily, mixed use.
And a really special thing about it is it's Highland Park schools.
Yeah.
Which is like, there's not really any multifamily in Highland Park schools.
So very similar to City Center, how you're zoned to the really good schools. You're in the walkable retail amenities. But so that's kind of an outlier. And then if you went and looked at some of what maybe Streetlights has done in the Knox Henderson area where they're building super, super high end, big units, more boutique. It's just so expensive to build. They're taking a big bet and they've kind of got a formula and they've done it and made a lot of money and done really well, but you only can build so many of those. What Trey and I have been telling developers, we've had this conversation now a couple of times just in the last few days with groups from out of state and groups from like Houston and just other markets, is if you're going to develop urban in DFW right now for multifamily, you're pretty much going to have to be really core. So you're going to have to be like Uptown, Knox Henderson, maybe Oaklawn, or you're going to come out and go to like the next ring out. You're not going to be trying to do anything like just off the fringes of downtown. It's like those areas just don't make sense at all. So there's like this ability to maybe go get a high rise done, but then you really can't get anything done just outside of that, or you have to come, further outside town. So our stories might be somewhat similar to Houston, except for maybe we just have a little more robust high rise market at the top end.
Yeah, I was saying, I don't think Houston has a high rise market today. I don't know if you disagree, David, but I don't see that at all. I think if we have any infill play at all, it's just the for wrap deals, and probably really $50 to $70 foot to the dirt is what we're seeing. And I think you'd have to underwrite $250 rents, but we're seeing $200 to $220 rents in those markets. So that makes it kind of tough.
The last high rise site that we sold for a high rise was to Southern Land about 3 years ago. Unbelievable site on Kirby, probably the best site in the city in my opinion. But that's not even just a straight residential deal. They blended uses. So they're doing a high-rise multi with, I can't recall exactly, but maybe roughly around 50, 60,000 square feet of office and then a retail component as well. So other than that, the only other high-rise resi deal that's being built here in Houston, and correct me if I'm wrong, Tim, is the Hanover deal over off Post Oak Lane here in the Galleria.
Yeah, but I think that the point is neither one of those pencil. Even when you add in the retail and the office, those are just long-term holds. And
That's right.
They're not doing those deals because they can underwrite today. They just know it's incredible real estate, like you said. And, some of these sites, if you don't get them when they're available, you're just never going to be able to get them. You can't wait till the market's good and then go get them. These are markets where, like on Kirby, if you go offer someone $400 or $500 a foot for their site, they don't sell it to you.
Yeah.
They're just, people just don't sell some of these sites. So, but Houston, I just don't think we're going to have a high rise play, here for a while that actually makes economic sense. Like we said, I think where you really are going to see any kind of infill development is more of these, well located, but kind of fringier urban sites, and probably $50 to $70 dirt, and their wrap deals, and they're targeting mid $2 rents, and you're seeing $2 to $2.20 rents on the ground. So it's not very compelling, but there's not supply, and they're great submarkets. So you'd think that if things can recover a little bit, that we'd see rent growth in those markets.
Which on that note, I've got a shameless plug. We've got a site in City Center,
Yeah, that's right.
2.25 acres that you can buy,
Yeah,
multifamily or any other use for that matter.
yeah, that's a good site. It sounds like rents in Houston are probably maybe 10% or so lower than DFW, but then we've heard that costs are about the same. Like it's maybe about 10% less to build in Houston than DFW, which is interesting. But from an equity standpoint, maybe we talk a little bit about equity because that's what's been the most difficult on all these development deals. Debt now is pretty easy. So it's interesting how when rates first went up, debt was almost impossible for like the first 18 months or so. And then really now the last couple of years, equity's gotten tight. And I'd almost say that equity's gotten more tight this year than it was last year, at least in DFW.
I agree.
We're seeing more and more groups struggle. And it's, you feel for these developers that are stuck in these sites that they bought back in 21 or 22, and they've been waiting, thinking the market's going to turn. And now it's like, here we go again, 2026. We've said a couple of times on the podcast, we feel like 2026 is a little bit of 2025 all over again, but it's pretty discouraging to go through it and just realize that we haven't turned the corner yet from an equity standpoint. It's still very challenging.
To me, it feels a little bit like we're kind of bouncing on the bottom, and maybe we're seeing a true bottom. Because then when you look at markets and you look at what is an actual bottom, it's when there's no hope and no one has any confidence in the future that things are going to get better. It just feels like things are going to just keep getting worse and spiraling downwards, and people start making decisions because of that, just to sell or get out, or for sure not to commit to new deals. And in some ways, it's a little bit encouraging to me because I think it's an overreaction. I think there's a lot of opportunity in Texas in these markets like Houston and Dallas, and we're huge believers in Austin and recovering. And so to me, it feels like maybe 2026 is the bottom, and we're starting to see that those kind of things happen in the market that show that.
Let's talk a little bit about some of the meetings we've been having with developers, some of the deals we've been closing, and what we're hearing. Let's start with multi from an equity standpoint, because that's probably, in some ways, that might be the most interesting conversation, just because we're seeing groups have to get really creative in how they're looking at the capital stack to get projects through. Even deals where you would think, oh, there's no way that sponsor on that site isn't going to find a partner. And then you'll hear that they had to drop the site because they had no equity interest, or you'll hear they needed a 20 or 30% retrade on price to get the deal closed. We've been seeing that even from some really quality sponsors just to make a deal pencil. Trey, do you want to speak maybe to Dallas a little bit first from an equity standpoint, then we can talk Houston?
Yeah, for sure. I think the overarching thing that we're hearing from a lot of developers, like you're alluding to, is just how challenging equity is right now. We've heard from several people who've been in the business a long time that this is one of the hardest times in their career to get equity on deals, and not necessarily even talking about, it's like you said, deals that are up the fairway that you would think can get done. They're still challenging. They may be fighting just to get one term sheet. I think that the big things that everyone's focused on, obviously, is supply, right? And so the deals that are getting done seem to have a better supply story. But to your point, there's a place right now where deals are almost having to be completely ready before groups can get an equity partner on them. And so it's really putting pressure on groups to spend more pursuit dollars on their own and get deals farther along and take a little bit more risk than they normally would, just to get to a place where equity will get on board with it. And so a lot of these groups are saying, hey, by that point, we're already $2 million into the deal. There's a lot of risk there, which that's been really interesting. And so, I mean, I know you're having active conversations as well. It's like groups are almost trying to find ways to get partners on board earlier so they can potentially have a chance at sharing some pursuit dollars.
Yeah, we've been approached recently by some of our developer clients just asking if Ascent could help be involved in a lot of different ways. Like we pursued a large multi-phase site with a developer client where Ascent was going to take the second phase, so because they couldn't capitalize the overall project as one project, so they needed to split that up. We had another one where the client was looking for Ascent to come in and cover the pre-development costs and create a structure where we would cover those pre-dev costs so that they would be able to move forward, put the property under contract, and try to get it to a point where they could get capital. Because what we're finding is capital really doesn't want to sign off on a deal until you have full plans, you know exactly what it's going to cost, and they know that they can get a shovel in the ground at a specific date. And it's hard for these developers because these projects cost like $2 million in pre-development to get to that point. And like this client specifically told us that the reason that they can't go put this out under contract and spend that pre-dev money is because they have so many existing assets that they own that they haven't been able to sell, that they have to be able to recirculate some of that capital before they can go put it into new projects again. So we're starting to think, there's some opportunity on the Ascent side to partner with some of these clients. And so we're looking at those kind of deals. We've already done a handful of joint ventures where we've bought the land, rolled it in with these clients. But right now it feels like it's really difficult for multifamily developers in Texas to figure out how they're going to close and capitalize the land and how they're going to figure out the pre-development costs. Even if the site's like a really good site, because the equity, we had a client tell us this yesterday, the equity told them, we love the deal, we're really interested, but if you think you can break ground on it by the end of the year, call us in November, and we'll talk about it then. And the client's like, well, between now and November, we have to spend like $1.5 million. So are we going to go take that risk? And then we call them and then they say, we're over allocated right now. Like we just can't, we can't do any more right now.
Yeah. And I think even to that point right now, very live time in the market where we're seeing some deals. One is a lot more of the private groups who have some type of a balance sheet, some type of a capital backing where they can see past all the things in the short term and be able to actually fund those pursuit dollars themselves. And so there's some deals that we've done where it's been most of the private guys are competing at the top and they have the ability to go clear DD and get almost to the finish line before getting an equity partner.
Yeah, you guys were saying in Dallas, you guys have some deals that have, I think $1 million, $2 million hard and full plans and can't get capital or are close to closing on the dirt and don't have capital raised yet. So that's pretty crazy to get for a developer to get in that kind of a position, because a lot of times the seller doesn't just keep giving you more time. You may just lose a deal. They may try and go with someone else or pull off the market or something like that.
Yeah, we have several deals that are supposed to close in the next few months that have 7 figures, non-refundable, designed projects that groups are telling us they don't have equity on and they're just not sure what the finish line is going to look like.
Yeah, and a lot of those groups have learned, from this last cycle that you don't really want to end up owning the land if you can't get equity. Yeah. And so it'll be interesting to see what they do. I mean, we saw that back in 2022 when rates went up. Trey and I had a couple projects where developers walked away from close to $3 million in pursuit costs. They just walked away, because they couldn't get capital. They didn't want to take the land down. And I remember that happening in Houston too, and some of the cycles that we've had where developers walked away from full plans on projects. And I think the big institutions right now, Trey, you were saying this earlier, they feel like they've got all the leverage on all these developers because
a lot of the mid-size equity groups are not outplacing money right now. And so a lot of the top guys who still are putting money out feel like, hey, this is finally the time where we might be the only people at the table and we can force a little bit better terms for the equity partner.
I mean, we're mostly seeing the Japanese invest right now in multifamily and DFW, and not even just multifamily, but in the companies. We met with another developer the other day and they're like, yeah, we just sold to the Japanese too. Yeah. They just bought a stake in our company. It's like almost all the big merchant built multifamily developers have sold a pretty significant stake in their companies to Japanese companies. Like the Europeans are not investing or they're so slow. And the Japanese have been investing a lot. You still have some of the big players, like Carlisle, but they're so selective because they own so many sites that they haven't been able to sell. And then you have
they're seeing all the best sites too. I mean, they're getting shown everything.
Yeah.
And you have the small private developers that Trey's referring to, which is great. But the challenge with that is they can't go do a ton of projects.
Yep.
So it's, from a market standpoint, it just means that across the market, it's challenging. And so it's interesting. It's challenging to get these new sites done, to get them capitalized and built, even well-located sites. Like we're talking about sites in Plano and sites in Dallas and good, well-located zone sites that some of the top blue chip multifamily developers, sponsors can't capitalize. So then you compare that to a lot of these owners, smaller developers that bought these sites in other parts of the market in 21 and 22 and put debt on them. Mm-hmm. We're tracking a lot of those where been extending now like 4 and 5 times. And we've been trying to help educate them. Like, you're kind of like living on a prayer that things are going to somehow like skyrocket back, because people aren't even really looking in your area right now, but you're still believing that you're going to get to this like really high value, but your debt's due again in 6 months.
Yeah.
And it's amazing how we were talking the other day, we were chasing a deal really hard with one of our big developer clients. And the guy seemed like he was just being so unreasonable. And it was like, this is just so weird. And then we found out that he ended up getting foreclosed on. Mm-hmm. And so it was like the whole time, he was trying to hold the line and get something that was really unreasonable. And then ultimately he lost it.
Well, the unfortunate thing for a lot of those groups is, riding the market down, like last year and even the year before, we actually had better offers in some of these sites. Right. And now that we've sort of hit like a new reality. And so now the offers, are going down even more. Now they're 20% lower than they were maybe a year ago or 2 years ago. And in some cases, there's just no one who even thinks they can get it capitalized, where maybe in the past people thought they could. But yeah, in Houston, we're seeing a lot of the same. We actually have a really good infill site that we're excited about, that we've had a lot of offers on. And we have a best and final with 3 groups to choose from, all very quality, well-known groups who do deals across the country. One of them has to get institutional equity. They could do friends and family, but they're probably just going to do institutional. One is able to use their balance sheet, and then one raises private capital and has been successful doing that for a long time. So obviously our seller is going to make the decision, but we're advising them just on the risks of that, and where the capital markets are right now. For him, it's they're all very close on price, but he really wants the deal to close. Yeah. So he's willing to look at even a little bit of a discount just to get someone who's able to get it closed, versus getting tied up for 6 months and then restarting 6 months from now if it drops out.
And this is in a sub-market where you're seeing wrap product being built. This kind of goes back to what we were saying earlier. In order to get a project like this capitalized, it has to differentiate itself from all the other deals these groups are seeing. And this project does. And I'm not just saying this because it's our listing and we're selling it. It's in a sub-market that's a really good infill sub-market where people are building wrap product. But on this site, you don't have to build wrap product. You can build surface park. So they can come in, their costs can be lower, their rents can be lower than what we're seeing in the sub-market. And what's crazy with all this, we're talking about Houston and Dallas, which are probably 2 of the better markets across the country in terms of just population growth, job growth. Yeah. So I'd say we have it good compared to most of the rest of the country. I saw the population numbers the other day. I think Texas had, I can't remember if it was 7 or 8 of the top 10 fastest growing cities in the country. Anna, Salina, Melissa, Fulshire. Yeah. These are all, Houston and Dallas suburbs. So crazy to think we're talking like this in our markets where things are actually, like I mentioned, from a population job growth, pretty good.
Oh yeah, that's right.
Yeah, I think DFW is probably the number one market that people want to be in right now for multifamily development. But then it's just the fundamentals are challenging. And what you have across the country is you have a lot of probably overdevelopment that happened in the South the last couple of years, but then you have almost no development that happened up in some of these northeastern areas. So their markets are a lot tighter, but because of regulation and just lack of development, they almost have no housing supply. So they're not growing like we are, but their markets are tight. Because you'll hear about guys developing in some of these other places, and you're like, how is there demand there? But they just don't get as many projects done. And down in Texas, we're so pro-development, pro-business. We talk about like barriers to entry, but it's hard to find areas that truly have barriers to entry.
Yeah.
I was just going to say, where we're seeing deals get done and how developers are capitalizing multifamily projects, it's been more just on the creative financing side. And so, everything from more like LIHTC, there's a lot of 4% out there. There's a lot of developers that are chasing those deals. If you're in a DDA or QCT, there's so many bonds available right now for affordable housing. The biggest challenge is getting the political support from the city to be able to get the letter of support to get the project through. But the bonds are going to be there if you can. So those LIHTC deals, we're seeing a ton of activity. Trey and I are inundated. Mm-hmm. The biggest challenge is just most of the cities don't want to play ball. So there's a lot of great zone multifamily sites that wouldn't have been available like 2 or 3 years ago because the market rate activity was so strong, and now it's gone. And the LIHTC developers would love to buy those sites, but the cities won't support it. And then we're seeing, just bond deals, still some HFC deals, a lot of HUD 221D4 seeing a lot of those deals get done.
It's really interesting too, because it's some of the most high-end developers in the business that you wouldn't expect to be out doing a PFC or an HFC, but that's just, they're using their name to go approach and get city incentives and PFC or whatever they can do just to try and, make a deal work, because that's what you have to do right now. The other side of it too, and I do think one of the places where you can get equity a little bit easier that we've talked about is just being back more urban. And I know David mentioned it for Houston, but for Dallas, we're following the capital story, and the capital story is telling us to be more urban, wrap, where you can build stick frame. There's been less wrap projects built over the last 3 to 5 years. And so the supply is lower. And I do think while it may be a little bit harder to get that first couple term sheets, it's definitely seems to be the area where you are going to get more traditional equity and be able to work something out.
Yeah, it's always interesting to watch the equity move almost like from one end of the spectrum to the other. It's like it's all suburban, or suddenly now it's going to be all these wrap deals. And so it really is where a developer can go get capitalized today, but it's probably going to be, we'll be talking about the suburbs again in 30 months, because it'll be, there'll be so much development in the urban market that we'll be back talking about the suburbs. I'd say the other thing we're seeing on the projects that are getting equity is a lot of pref. And so we're seeing developers go higher up the capital stack than we've traditionally seen, up to 90%, where you're getting your traditional loan, you're putting a lot of pref on top. I mean, significant. Some of these deals, 20 million in pref on a single deal. Developers willing to co-GP, and these are larger developers like actually giving their promote just to do a project. We're seeing that. Developers are just getting as creative as they can to get these projects done. And so that's where, yes, it's a highly desired market to be in DFW, but it's not easy right now on the equity side.
I was going to say, it's interesting you're talking about in Dallas, the kind of the wrap, you feel like equity is going after infill wrap. I'd say in Houston, we're definitely in a more difficult, probably capital environment than you guys in Dallas. But I would say most of the focus is still suburban, even though that's really hard. We're pushing hard in the infill market because we think there's an opportunity. And there's a couple of groups who are serious about trying to do it. But wouldn't you say that 90% of the activity is still suburban and interest is suburban?
Yeah, 100%. And we've just started to see the infill activity pick up. And like Tim said, it's not like a bunch of players are coming into the infill market. It's a select few. But we've just started to see that pick up just in the last, call it 90 days, 60 to 90 days. So yeah, it's definitely not, a wave of, developers coming into the market. It's a very select few. And, my expectations are that number increases over the course of the year. And so we'll see more players. I mean, we've already seen more players just in the last 90 days go from maybe 1 or 2 groups looking to maybe 4 or 5 looking. But it's still not most of them are still out in the suburbs.
Mm-hmm. Yeah. When you say suburbs, is it more traditional or even maybe not even fully traditional, but like 3-story garden workforce? Or is it higher end 3 and 4 story, more core suburb sites?
Yeah, it's higher end, core suburb. We're not really seeing workforce anymore. We saw that the last couple of years, but I would lump in like even the energy corridor and suburban, which I know is considered a little bit more infill for Houston, but anywhere you can build 3-story garden or 4-story, surface part deals that are more of like you're saying, a core play where there's jobs and maybe some retail, higher end demographics. We're not really seeing like some of these deals at Houston. We had a lot of activity in the last couple of years, just these workforce kind of, somewhere in the suburbs off a major street, seeing deals go up. I mean, I feel like that's pretty dead now. I think there has to be a strong story. And really in those cases, there's actually some pretty decent rents on the ground. They're, like we're saying, comparable to some of these infill markets, where you're seeing maybe $2 rents or even north of $2 rents. And there just aren't that many of those. I think when you look at Houston, there's not a lot of submarkets where there are barriers to entry and there's high-end demographics and there's a site. Yeah. It's just a lot of times those kind of markets, there's not even a site, so it makes it tough.
The story I think is pretty similar between our markets and the biggest difference is zoning, because
Yeah.
So like the energy corridor would be for us what we would refer to more like an urban area, but then the way they zone it is they make the minimum zoning 5 stories in those markets.
Yeah.
So like if Houston had zoning, the energy corridor would probably require wrap. And so that's the type of wrap we're seeing get built is more in those type of areas. And then areas like Washington corridor, if you compared that to Dallas, like no activity. So that's where that would be like east.
So like in the energy corridor, we're seeing 3-story garden.
Yeah.
That's how cheap the dirt's gotten there. But even with that, we recently had a group who put us out on a contract. It's a 3-story garden site and went to equity and just got turned down by everybody and dropped it, pretty quickly. So, you would think 3-story garden that close in on a major freeway, you could maybe make that work, but they couldn't get anyone to bite on it.
Yeah, and you're talking like from a land value perspective, because in the energy corridor, there's been a handful of wrap deals built, and that was at the height of the energy corridor. So we're dating back to kind of 2013 time period.
15, yeah.
I mean, we saw where land's trading now versus back to 2013 through 15. I mean, you're talking maybe a third of what it sold for back in that time frame, and maybe a fourth.
A fourth off the highest comps. Yeah, you had dirt trading in the $80 range, low 80s, and now we're talking about high teens to kind of low 20s. So I mean, that's a shocking. We talk a lot about how land doesn't always go up in value. That's a pretty amazing example.
But that time period, 2013 to 15, the energy corridor was probably the hottest submarket in the country.
Yeah.
Did you have something, Trey?
I was just going to comment on something Tim said, but I guess just back to DFW, the one suburban, just larger pocket that we've talked about continuing to get stuff done is really the area in between Dallas and Fort Worth, especially like mid cities, Grand Prairie. A lot of projects are doing well in Grand Prairie. It's one of the only places in DFW right now that people are actually starting to tighten concessions, which is exciting to hear. That there's starting to be some tightening. I don't think we've talked about concessions being reduced for probably 3 years plus. So that's definitely an area where people are still bullish on doing 3- and 4-story garden.
That's an interesting story because that goes against a lot of the other trends we're seeing, because Grand Prairie would be where you've been able to go build more of like a workforce product. There's also been a ton of supply. There's almost been like no barriers to entry. I mean, there's been so many units built, but it's actually held up. And I think the reason it's held up is jobs, because it's central to Dallas and Fort Worth. So it's between the two cities, incredible access to freeways, 20, 30, 161, 360, all that. And then just even with that type of product built, David, you referred to population growth and job growth. It's like the proximity there to jobs versus people living way up in Collin County. It's not that there's not demand to go do projects way up in Collin County, but there's just a lot fewer jobs that you can go access. And so I think it might just be that area, that Grand Prairie, Arlington area, it's more of like a true multifamily renter market. And that's what these developers are finding, building these projects. But you can't just go replicate that in a lot of other parts of town. But that thesis is working there because of the jobs.
It sounds like maybe there's a little bit of an overreaction. We had so much workforce get built, and a lot of it was not very well located. People were just building deals because they were cheap, and they didn't get the rents they needed. So now you have it swinging back to, we need to go build really high-end deals. We're going to have they're going to be high basis deals, but we're in really good markets, but we need these huge rents to make them work. And there's probably an in-between product that you need, which is more of like a workforce or an A-, just kind of bread and butter product, but in the right locations where you actually have multifamily renters, and which it sounds like is what you're talking about,
Yeah, I mean, there's a group that we're working with up here that I think is doing it really well, Tim, because they're doing what you're saying. They're building wrap, but at like a lower end in these good locations, closer in, off the freeway, and they're able to deliver. Like we just had a best and final. And on one of these deals, they were not compared to everybody, but compared to some of their bigger competitors, they were like a good 10 to 15% lower on all-in construction costs. And at the end of the day, like the renter living in that location off the freeway, it's like, I mean, to what you're talking about, you're trying to play off proximity, jobs, access. Do you really want to go build over the top on just a site off the freeway? It's like that thesis doesn't make a lot of sense. I think that makes sense in a really one of these like city center, Knox, Henderson areas where you need to go build something a little bit nicer because you're targeting that market. But these, just like a deal off I-10 or a deal off 610 or a deal off, 75 or 635, you need to figure out a way to build it more affordable. Mm-hmm. I think that's what's going to work.
I think there's two comments there. Is just like, it goes back to the placemaking, right? And people don't want to build the deal that's out on an island right now. And tying it back into the equity conversation, like there's just more pressure on picking a site that has good visibility, that has either highway frontage or, good access in some type of a mixed use environment. Like those are the sites that people are actually getting bullish on versus, hey, it's just, you go turn left and it's the second cornfield from the left.
Well, and equity's not letting you trend rents and say like rents are going to grow, X amount. I mean, you can't right now. And so when we were looking at some of these best and finals, and you're looking at all in cost basis from a developer. So then you're like, okay, well, what rents do they have to charge? So it's like, do I want to sign up the group that's charging rents that are 15% above the highest comp on the market? And their argument is we're going to build something nicer. Yep. And renters are just going to show up, knowing that we're in DFW and there's like going to be however many other projects to go drive to down the street, that are also getting built. Mm-hmm. Or do I want to pick the group that can deliver maybe at or below current rents in the market? And so that's just a challenge right now with equity. They're not going to buy off on the bigger rents like they were years past just because the market was hot.
The funny thing about it all is like the market's not reacting the way you think it would. Like here we are in a time of inflation where people can't afford as much, or a lot of people can't afford as much on what they pay for rent. And, the rents are going down where you would think it would be a flight to affordability versus a flight to quality. Yeah. But Tim's right, the affordability, the workforce housing, we're seeing that slow down, and it is more of the equity being attracted to that flight to quality. Yeah. So it's funny, you would think it would be working the other way.
Well, the other thing that I think is a critical factor is the groups who have in-house construction versus the groups who have to use a third-party GC. Mm-hmm. We're seeing just a big difference in who can get deals done based on that, because you have a big difference in construction costs between those two groups.
Yeah. It's an interesting point David makes. We were talking with a developer who we do a lot with up here that, they build more fringe suburban garden type product. And we were asking them on a site, like, how can you make this deal work with where the price per foot is on rent for that area? And they're like, we just don't look at it that way. We look at it as a teacher, a service industry person, a nurse right out of college. They're not looking at what is the price per foot in the area and all that. They're looking at, hey, can I afford $1,500 a month? And it's that simple.
Yeah. Yeah. And the reality is, you're right, David, about, I was looking at that same article that was saying that Salina and Melissa and Fulshire and these cities are growing so fast. Some of them have added a lot of apartments. Some of them haven't. But those that have, we just have to work through those apartments. But those are going to be good markets. There just has to be the right delivery of units. And it's interesting because that same article was saying that some of the more well-known bigger cities actually lost residents year over year. So like Dallas got smaller from a population standpoint, and so did Plano, which is interesting. So I think Dallas is trying to figure out how they're going to compete with some of these northern suburbs that are growing so much, like the city of Dallas, because you not only have groups like the Stars wanting to move out to Plano, and then you even have almost potentially losing the Maverick, which by the time this records, who knows what the Mavericks will be doing. But it's like that. There's all these jobs. AT&T left downtown Dallas to go up to Plano. So you have all this growth in some of these markets outside. It does make you wonder, like, just because you're close to downtown Dallas, does that mean anything? It actually may not mean anything good, to go build a project just because it's close to downtown Dallas. I mean, the amount of, I don't know what the stat was, Trey, on vacancy on office buildings in downtown that you sent me, but it was pretty significant vacancy.
Yeah, I think it was something along the lines of actual downtown Dallas has like 30% occupancy on their office supply.
Golly. Yeah, it's like crazy. Wow. It's just not there. Yeah, Lucy Billingsley was quoted as saying we need to take down like 8 buildings.
Yeah, and some of the buildings that they were talking about can only get up to 70% occupancy just because of the infrastructure and the parking requirements just have changed. So it's really interesting.
Yeah, it's a problem. Thinking about what could change and could kind of change the story we're talking about with just equity being so tight. One conversation we had the other day with a client was we had a deal that we were chasing 18 months ago that we couldn't get zoned, but we had 4 term sheets from different equity sponsors. And now, fast forward, we actually came back on the deal, got it zoned, and now all that equity is no longer interested in this deal. And he was telling us that one of those groups, they have had to set aside like an extra 10 to 15% of their fund, which is over $1 billion, just for problems on assets that they own. And I think that's a big story. Is a lot. We talked about it on some previous podcasts. There's so many apartments that got built, and they haven't been able to recycle those and sell them and return the capital. And so we need that to happen. And I think until rates start to come down, we're probably not going to see that happen. But if rates start to come down and that starts to happen, that's really going to suddenly free up equity for development again.
Yeah, I was talking to one of our clients they said they have 30 deals they've built in the last couple of years that they haven't been able to sell. And it's the most they've ever had they're sitting on. And they're like, until we sell a lot of those deals, we just have to be very careful what we do, how many more deals we take on. And so I think you're right, Tom. I do think it's interesting. Kevin Warsh, as we're recording right now, has just been appointed the new Fed chair. And there's a lot of speculation that maybe not immediately, but maybe, later this year and next year, he might start to lower rates. And so I do think that could help a lot just to increase the liquidity in the market. If a lot of these deals sell, the capital gets recycled. But there's a lot of other challenges besides just that. So I don't know if that's going to be enough.
Yeah, I think we're going to need something like that to happen.
Thank you for listening to our podcast today. If you have questions about land you own in Texas, send us an email at texaslandguys@dmre.com and follow us on LinkedIn to stay updated.